Hello, everyone, and welcome to our ongoing webinar series. This September edition is called Optimizing Retirement Income with Tax-Efficient RMDs. My name is Tom Bittinger. I'm with the marketing department here at Wealth Enhancement. And before we get started, I got a couple quick housekeeping items to go through. Number one, there will be a Q&A session at the end. It might be very brief, but we'll try to do something anyway. So feel free to submit questions using the questions pane on your GoToWebinar menu. Anything we don't get to, we will have your advisor reach out to you individually to answer those questions. And this session is recorded as well. So if you need to duck out for anything, don't sweat it. We'll send out a recording as soon as it's available. Today's presenter is Dave Mace. He is a certified financial planner here at Wealth Enhancement. He is on our advanced planning team. He's got a BS in human resource management and an MS in personal finance planning. He's been with the team here since July of 2023. Dave, thank you so much for being here, and take it away.
Thanks, Tom. I appreciate you allowing the advanced planning team to contribute to these webinars. And today, as Tom mentioned, we're going to be talking about the required minimum distributions and some different ways that may be available to you to possibly reduce some taxes or eliminate some taxes as those RMDs come into play. So what are RMDs? Everybody throws that term out a lot. It's required minimum distributions. And every person who has any kind of a tax-deferred retirement account, like a traditional IRA, 401k, 403b, those are the accounts that will have required minimum distributions once you reach a certain age. And so the age that usually starts, it used to be 70 and a half. With some of the regulatory changes that they've passed in the last number of years, that age keeps creeping up. And right now, if you're age 73, or age 73 would be the age you start if you were born between years 1951 to 59. And then after 1960, that age then is increased to 75. And why did they do it? Well, I think it's, that's a pretty easy question to answer. The government wants to get some taxes collected on those funds that they allowed us to defer into those accounts over the years. When it comes to calculating RMDs, the amount you must withdraw from year to year is based on the percentage of the total assets that you hold that are subject to RMD. In general, you determine the percentage using a lifetime expectancy from the IRS's Uniform Lifetime Table, which we'll look at on the next slide. So as you can see, the slide, this shows the lifetime table from the current one from 2025. Green columns represent the age, and the white columns represent the expectancy factor, or the number of years that you have left to draw from the account. So as an example, let's say that you just turned 73 and you have to take an RMD this year. By using the table, you can calculate age 73. If you go to the top left, you would have to withdraw about 3.77% of your eligible assets for that first RMD. And how do we get that 3.77%? Well, you take, let's just say that you have $100,000 in the account, and you divide that by the lifetime factor of 26.5, and it comes out to about 3.77. So that's where we get the 3.77%. So let's say that you can just move that across or move it down depending on how old you are. If you happen to be 75 this year, you're going to have to use the factor of 24.6, which comes out to about 4.07% of the assets, of the eligible assets. And 79, you would have to draw out about 4.74. So you can see that as you get older, the size of your RMD increases. And the reason for this is you know that the federal government wants to fully drain your accounts in your lifetime so they can collect those taxes. So to help show you what this looks like, let's pretend around you turn 73 just this past March. What this means is you're required to take an RMD for 2025, but the IRS does allow you until the end of March of 2026 to take that first RMD. So you have to do it by April. That's actually April 1st is the deadline. It's got to be before that. And so you would have to calculate what your RMD is for 2025. You don't have to take it until the end of March of next year in 2026. But keep in mind, if you do that, if you choose to delay that first RMD, you will have to take out 2 RMDs next year for 20. You'll have to take out your 2025 RMD and then also your 2026 RMD by December of next year. So what happens if you don't take out the required amount, the full amount by the due date? Missing the RMD deadline can be costly because if you don't take out your RMD by their deadline, the IRS imposes a steep penalty. It used to be 50%. With the passage of the Secure Act 2.0 in 2022, they did reduce that down to 25%. And if you take corrective actions within a specified correction window, then that penalty is further reduced to just 10%. So that has gotten better, but regardless, it's important to plan ahead and make sure that you meet those deadlines to avoid those unnecessary costs to your IRA. Moving on now to how RMDs are taxed. It's actually pretty straightforward. They're just regular income. You put off tax when you make the contributions into your tax deferred accounts, and then those accounts are able to grow tax-free. So when you take your RMDs, they're taxed as regular income. And to many of you, possibly most of you, this is probably pretty ho-hum, not a big deal. It's your money. This is why you invested it and saved it. Now it's time to use it. Makes sense, it's taxed this way. But there are a lot of other people who can potentially be negatively affected by RMDs because you have to take them, whether you need the money or not. And by being forced to take that extra income that you may not need, you could potentially shoot up into the higher tax bracket than what you had previously been in. And in these cases, the RMDs could start costing you money in the form of higher taxes. So let's just take a look how this could happen. Let's say, pretend you're 73, you're fully retired, and you are a widower or widow. You did a bunch of traveling and stuff early in retirement. So now you live pretty modestly on around $40,000 a year from savings, and then $20,000 a year from Social Security, coming to an annual income of $60,000, putting you in the 22% tax bracket as a single filer. Now, let's say in addition to your savings, you have a 401k from a previous employer and a traditional IRA that total about $1.5 million. Going back to our calculation of RMDs, in our uniform lifetime table at 73, the first RMD you would have to take out of those accounts is a little over $56,000. When you combine this RMD, which you have to take, with the income that you previously had been living off of, your new income is $116,000, which now puts you in the 24% tax bracket. So while yes, you're taking in more income, it's being taxed at a higher rate, meaning more of it is going to Uncle Sam's pocket, not yours. And that's just one basic example. Maybe at 73, you're still working. Now you have an unnecessary RMD on top of your normal income from your job. Maybe you turned 73 earlier this year and decided to delay your first RMD to next year, meaning you have to take the RMDs in a calendar year, 22 RMDs in a calendar year 2026. These 2 RMDs could bump your income way up. That's why it's just as important to be tax smart when you withdraw as it is to be tax smart when you save. Because there are more strategies you can implement to potentially reduce your tax burden when you take these forced withdrawals. So what are some of the tax saving strategies? Well, the first one is a Roth conversion. Remember when we talked about which accounts are subject to RMDs? You may have noticed Roth IRAs were not on that list. That's because they're funded with after-tax dollars, meaning the tax is taken out of each contribution before it enters your account. So when it's time to withdraw, you have already paid taxes on those distributions. Simply put, the Roth conversion involves transferring retirement funds from a traditional IRA or a 401k into a Roth account. And when you do this, you eliminate both the need for the RMDs and the tax burden on those distributions, whenever they may be. On the flip side, Roth conversions require you to pay taxes at the time of the conversion when you move your money from a tax-deferred account into a Roth account. This is one reason it makes sense to execute a Roth conversion during a lower income year, because you pay less taxes to move funds in those years. And that's why it's typically a good idea to perform a Roth conversion after you retire, but before you need to start taking RMDs. This slide illustrates how your income changes relative to your spending needs through retirement and how Roth conversions can help you lower your taxable income. So to understand how a Roth conversion might work in practice, let's tweak our previous example. You're still a retired widow or widower, and before retirement, let's say that your income was about $90,000 a year, which in 2025 puts you in the 22% income tax bracket. You retire at age 62 and your taxable income drops to $40,000. Assuming income tax rates don't change, this drop in income takes you down to the 12% tax bracket. At age 66, when you file for Social Security, your taxable income rises to $70,000, pushing you up into the 22% tax bracket. And at age 73, RMDs kick in, which causes your taxable income to jump well over $100,000, exceeding your actual living expenses and pushing you into the 24% tax bracket. This is where you get taxed more on the money that you don't even need. But between ages 62 and 73, you have a window to perform Roth conversions that accelerate income into years where your lower tax rates are possible. The next strategy is using a qualified longevity annuity contract, or a QLAC, to help reduce your RMD. So what is this and how does it work? Well, for starters, a QLAC is an annuity contract. An annuity is a financial mechanism wherein you contribute funds or assets like shares of stock or options into an account, and then that account distributes money back in equal installments to you on a regular basis, either immediately or at some point in the future. QLACs are longevity annuities owned inside a qualified retirement account like a traditional IRA, a 401k, a 403b, or governmental 457bs, or other employer-sponsored tax-deferred savings vehicles. This means that a portion of the assets in your accounts essentially gets removed and paid back to you in an annuity later on. QLACs can help you reduce your RMDs because if you own a QLAC in your qualified retirement account or retirement plan, the value of the QLAC is excluded from the RMD calculation until the year of annuitization, which can be no later than age 85. In general, a QLAC account excluded from the RMD calculation is limited to a lower of $135,000 or 25% of your retirement account balances. All other assets in the account will still be subject to the normal RMD rules. Let's take a look at what this means in actual numbers. Say you're 70 years old and have a 401k account worth $500,000. You set up a QLAC that's set to start paying out when you turn 85, with the value capped at $125,000, which is 25% of the 401k balance. Then once you have to start taking RMDs at age 73, the QLAC value is excluded. So your RMDs will be calculated on the remaining $375,000 balance, not the full 500. This reduces what you're required to take out each year in RMDs. And then once you turn 85, you start receiving annuities payments from the $125,000 that was previously removed from your account. There are a number of things to consider, though, before you go down this path. So talk to your advisor to make sure that this is a right course of action for you. The final strategy that we'll discuss today would help you reduce your RMD is called a qualified charitable distribution. If you've already been receiving RMDs that are larger than you need, then QCDs might be a good option for you if you also like to give to charity. The QCD strategy allows you to send payments directly from your traditional or inherited IRA to a charitable organization of your choice and have it count towards your RMD. This means that the charitable giving out of your IRA reduces your adjusted gross income, taxable income, and the resulting tax liability. It's important to note that this special treatment does not apply if you receive the RMD and then later decide to donate the cash to charity. Additionally, the maximum amount you can transfer in 2025 is capped at $108,000 per person per year. So while there is no regulatory limit on the number or the amount of contributions, we recommend talking to your advisor about what makes sense in your unique circumstances. While QCDs are a great strategy for many individuals, you will not get the full financial benefit unless your tax return is accurately prepared. So make sure to let your tax preparer know that you did complete a QCD when you go to file a return, because they won't have access to that information unless you provide it. This illustration shows how a QCD strategy might work. If you donate cash directly to a charity, even if it's cash you received as a result of an RMD, you may be able to deduct up to 60% of your adjusted gross income from your taxable income to reduce your taxes owing for the year. To claim that benefit, though, you would have to itemize your deductions. By donating your RMD directly to a charity through a QCD, however, you can exclude the full amount of the donation from your taxable income. If structured effectively, this could potentially lower your tax bracket and even reduce or eliminate taxes owing on your Social Security benefits. Additionally, you do not need to itemize deductions to claim the benefit of a QCD. So everything that we've covered so far applies to if you're about to turn age 73 or age 75, depending on when your RMD starts. From your own investment account. So what happens if you inherit a retirement account, maybe from a spouse or a parent? Do the same rules apply? Well, the shorter answer is maybe. There's a lot of special rules when it comes to RMDs when you inherit a retirement account. So we'll briefly go over those here. Required minimum distributions from IRA and qualified retirement plans after the account owner's death are based on the beneficiaries as of the determination date, which is September 30th of the year following the year of death. And so in this slide, it's just showing that if you're a spousal beneficiary, you have different options. You can elect to treat the IRA as your own. You can elect to keep it as an inherited or a beneficiary IRA. And depending on what you decide to do, there are different rules for each one of them. And so you have to make sure that you understand, what those rules are depending on how you fall into place as a beneficiary. Again, eligible designated beneficiaries would be a surviving spouse, a minor child of the IRA owner, disabled, chronically ill, or not more than 10 years younger. They have to use the remaining life expectancy of the year after death, or they choose to liquidate the inherited account by the 10th year, by the 10th anniversary following the date of death. And so the distributions must begin before the end of the year that follows the year of death. That's if they're before their required beginning date has come. And if it's afterwards, then the remaining life expectancy of the eligible designated beneficiary, if the eligible designated beneficiary is older than the deceased, then they would have to use the life expectancy of the decedent's age. So as you can see, we'll go through there. We're going to move through several of these slides here regarding beneficiaries. Not going to spend a lot of time going into the weeds on these because they're so specific to what type of a beneficiary you may be. Yeah, here we're talking about beneficiary IRA. Again, so many different rules depending upon where you fall as the beneficiary. So I guess the takeaway, we can go ahead and move through the next couple of slides. Trusts are another big thing that have their own unique set of rules as well. The takeaway here is if you are inheriting an IRA or a qualified retirement account, it is imperative that you speak with your advisor to make sure that you understand what all the rules are with regard to being a beneficiary of a retirement account. So to recap, I know we've talked about a lot really quickly here, but RMDs are required withdrawals from tax-deferred retirement accounts beginning at as early as age 73, maybe 75, depending upon your year of birth. They're taxed at regular income tax rates. Proper planning, though, can help you reduce the tax burden. Strategies like Roth conversions, QLACs, and QCDs can help lower that tax bill. And special rules apply for RMDs when you inherit an IRA. So you can have those, and they can be their own can of worms. So realistically, there's a lot more we could have covered today when it comes to RMD. So make sure that you do contact your financial advisor to discuss your options. And make sure to start this planning before you turn 73, because some of these strategies like Roth conversions can take some time. So when you want to make sure that you have all of your ducks in a row before you need to start taking RMDs. Or if you have an inherited IRA, on the other hand, that requires RMDs, reach out immediately because you'll want to start planning for those sooner rather than later. Tom, I'm going to go over some Q&A. I know we don't have a lot of time to cover those.
Yeah, we got time for a couple though, I believe. So the first one, are there any advantages or disadvantages to taking QCDs at any particular point in the calendar year? Is it better to take QCDs earlier in the year? Does it matter whether you take QCDs before you take the remaining RMD as income?
Yeah, that's a good question. So if you're going to be using the QCD strategy that we talked about, I think there may be some benefit in doing it earlier in the year. And the reason I say that is because the IRS looks at it as first dollars out are considered to be the RMD. And so if you actually are satisfying your RMD by making a qualified distribution, the IRS looks at the first money out as your RMD. And so if you take a withdrawal at some point in the year, and then let's say in December you decide you want to make a qualified charitable distribution, you're not going to be able to say, oh well, I meant for that earlier money to be part of this qualified charitable distribution. It just doesn't work that way. So if you're going to be making qualified charitable distributions, I think that the best thing you can do is determine that as earlier in the year. Don't wait till the end of the year, and get that taken care of first. And then if you do need to withdraw additional funds out of the IRA or retirement account later in the year, it's no harm, no foul. You've already satisfied what you needed to do from the qualified charitable distribution standpoint.
All right. I want to be aware of everyone's time. So we're just going to do one more question. If we don't need the cash from RMDs, but would rather invest it somewhere else, where is the best place to do that to minimize income taxes?
So, good question. There are actually quite a few different things that you can do. One of the ways, you can obviously put it into a taxable brokerage account if that's available to you, or you could open one. But investing in tax efficient, either like mutual funds or ETFs would be a good starting point, or a municipal bond fund or municipal bonds in general, because they're tax free. Maybe definitely at the federal level, but maybe federal and state both, depending upon your state. The other thing you can do is you could actually put some money into a donor advised fund, which we didn't talk about here, but it's a way for you to put funds into a charitable account, and you can actually reduce. Again, there's many rules around this, but the donor advised fund contributions can reduce your income in that given year. So other than that, you can, the main thing that we talked about earlier is trying to do, get a Roth conversion or a qualified charitable distribution, get those things taken care of before you have to start taking your RMDs.
All right, I think that's a good note to end on. So with that, I want to thank everyone for joining us today. Dave, I want to thank you so much for being with us. Again, any questions that we did not get a chance to get to, your advisors should be reaching out to you individually to respond to those. And again, just want to remind everyone that this session has been recorded and we will make the recording available to you. So check your inbox for that. And if it's not there, it'll be on YouTube. It'll be on our website. We'll make sure that you can get it and check it out. So thanks again, everyone. And I hope you have a good rest of your day. Take care.